You know, when we talk about the world's most valuable companies, we usually think of banks or software giants. But earlier this year, China's stock market did something that just about broke my brain. A memory chip maker, CXMT, went public and immediately shot up over 500%, briefly becoming more valuable than the biggest bank in China, ICBC.
That really was the big bang moment for China's AI financing strategy. But if you look just a little closer, you find the catch. Only about 6.7% of those shares were actually tradable. It was a massive, headline grabbing valuation built on a tiny, almost microscopic stage. This tells you it wasn't just about market demand, it was a very specific, very loud signal the state wanted to send.
Right, so that's the part that feels so strange. From a Western investor's perspective, a 6% float sounds less like an investment and more like a liquidity trap. You can't really buy or sell. So, what's the strategic benefit of having a $500 billion chip company that's essentially just on paper? It seems almost like a mirage.
Well, it's a very useful mirage. A valuation that high, even if it's artificially inflated by scarcity, does several things. First, it acts as a massive magnet for talent. Engineers want to work for the top company. Second, it allows CXMT to get much cheaper debt financing. Banks are more willing to lend to a company with that kind of market cap. And third, it's a huge morale booster for the domestic tech industry, which has been hammered by US sanctions. It's a way of pricing a nation's survival strategy in real time. This isn't about quarterly earnings. It's about shifting the entire country's economic identity from finance to silicon.
So the CXMT IPO wasn't just a one off success story. It sounds more like it was the opening act for a much larger state directed play to mobilize its entire $28 trillion capital market for this tech war.
Exactly. And they have to, because when you look at the private funding landscape, the numbers are just brutal.
The numbers here are startling. I was looking at the 2025 figures. US corporate AI spending was around $490 billion, while China's was only $98 billion. And the venture capital gap is even more of a chasm. For every $30 of VC money going into US AI startups, only $1 is going into Chinese ones. On the surface, it looks like China has already lost the funding war.
It would seem that way if you only look at private VCs. But that statistic is becoming a statistical illusion. China is effectively bypassing the traditional VC market. They're using state run tools like the Big Fund, which has pumped nearly $100 billion into semiconductors and AI. And they're issuing ultra long term government bonds specifically for AI infrastructure. They aren't waiting for the market to find the next big thing. The state is stepping in to build the thing itself.
Okay, but we've seen state led investment fail spectacularly before. I mean, we've all seen the stories about gold cities or wasteful subsidies. You mentioned these new government funding tools, like something called a new policy financial tool. Why should we believe this will be any different for something as complex as AI?
It's a fair question, but the model has evolved. It's no longer just the government throwing money at projects. They've created what you could call a forced synergy with their private tech giants. Companies like ByteDance, Alibaba, and Tencent are now under immense pressure to shift their focus from consumer apps to hard tech. ByteDance jacked up its AI budget to over 200 billion yuan. Alibaba is committing over 380 billion yuan. These companies are transforming from purely commercial enterprises into semi state actors, becoming the second engine in this double engine model.
So it's a state led, private supplemented system. This brings up a fundamental question about how to build an industry like this. Is it better to have 1,000 flowers bloom, like in Silicon Valley, or to build a single massive state-controlled greenhouse?
That's the perfect way to frame it. And it leads directly to the other part of their strategy. It's not just about funding, it's about what they're funding.
Right? There's a massive pivot happening here. Instead of just trying to outcode OpenAI and build the world's smartest model, it seems China is spending a fortune, nearly $300 billion, just on the physical homes for AI, the data centers.
It's a giant hedge. The thinking is if you can't reliably get the most advanced chips from the US, you build the biggest, most integrated domestic network possible. And here's the crucial part: the government is mandating that at least 80% of the technology in these new computing hubs must be domestic. Think Huawei's Ascend chips. It's a forced evolution experiment on a national scale, creating a massive captive market for its own technology.
That sounds a bit like the 19th century railway boom. Does it matter if the trains are a bit slower if you're the only one who owns all the tracks?
That's the bet they're making. The goal is to drive immediate productivity gains across their manufacturing and consumer sectors. Even if their AI models are 10% less powerful than America's best, they believe they can win by making the integration 100% deeper. But this infrastructure play is only one half of it. They also need to fund the brains of AI, the actual models.
And that's where the stock market comes in again, right? I saw that they're changing the rules.
Exactly. With venture capital drying up, they've relaxed the listing rules on their tech-focused star market. Now, unprofitable large language model developers like DeepSeek or Jipu AI can go public as long as they have a commercialized product and a certain valuation. They are essentially telling these high-risk R&D labs, don't worry about VC funding. The public market will subsidize your research. It's a direct transfer of risk from sophisticated investors to the general public to keep the innovation engine running.
So, when you put it all together, what are the big takeaways here? It feels like we're watching two completely different philosophies of innovation play out.
I think there are three key insights. First is this idea of the financialization of national security. China has turned its stock market into a weapon, where a company's value is no longer about its cash flow, but about its strategic necessity. Second, you have the greenhouse versus jungle models. The US is a jungle, survival of the fittest, fueled by private venture capital. China is building a greenhouse, state protected, publicly subsidized, and infrastructure heavy. And that leads to the third point, which is the structural divergence. The US is betting everything on building the smartest frontier intelligence, while China is betting on distributed productivity, getting a slightly less advanced AI into every factory and every city as quickly as possible.
We often ask who is winning the AI race by looking at benchmarks and the performance charts, but the real divergence might be far more uncomfortable. We are witnessing the birth of two entirely different species of AI. One is a high-performance private sector marvel optimized for the next breakthrough. The other is a state-managed utility optimized for national resilience. The real risk for the West isn't that China builds a smarter AI, but that they build a cheaper, more integrated one, while we are still debating the ethics of the frontier. In the end, the winner may not be the one with the highest IQ, but the one who builds the biggest engine. Is the world ready for an AI era where the most important innovation is actually $1 trillion government bond?